of financial institutions in the country in a move that could make it harder for locals to start banks and lead to consolidation among the small existing financial institutions. The central bank says the move will stabilize the sector and align it to regional peers. Bank of Uganda has proposed to raise commercial bank paid-up capital from 25 billion shillings to an astronomical 150 billion shillings. The paid-up capital for credit institutions will rise 25 times from the current 1 billion shillings to 25 billion shillings, while the paid-up capital for microfinance deposit-taking institutions will rise from 500 million shillings to 10 billion shillings. The finance minister is empowered by Section 26(5) of the Financial Institutions Act 2004 to revise the minimum capital requirements of financial institutions by a statutory instrument on the advice of the central bank, and this will be scrutinized, rejected, or approved by Parliament. The exponents of this debate of raising the minimum requirement say this will enforce opacity of the balance sheets, create stability, bring in much needed revenue from outside, but those who are against it say there's a threat of edging out indigenous players, which could lead to a monopoly. Before us this evening on Citizen Voices is a panel of three, which includes Professor Samuel Sejaka, who is an accountant and finance expert. We also have the Uganda Bankers Association President, Wilbrod Owor, and Abubakar Mayanja, a financial economist, this evening. I'm your host, Emmanuel Mutaiziwa, and welcome to Citizen Voices. Our hashtag is Amplifying Citizen Voices. First and foremost, Abubakar Mayanja, you've heard the debate. If I'm to quote the director of Bank of Uganda in charge of supervision, he says, the increase in paid-up capital is long overdue and is intended to match the dynamism in the economy, incentivize shareholder commitment, and enable institutions to withstand shocks and to converge with regional peers, amongst whom Uganda effectively has the lowest paid-up capital. In your view, what do you think is the rationale behind coming up with a figure of 150 billion shillings, Abubakar?
Thank you very much. Usually, one of the key components of having a sound bank is capital adequacy alongside, asset and liability management. So the historical factors that are driving this emanate from the 2008 and 2009 financial crisis, where banks imploded as a result of not having enough capital. And then coming back to Uganda in particular, there have been instances. For example, recently one of the banks, had to be taken over by another bank. And at that point in time, I think the central bank did undertake what is called a stress test. A stress test is something that is done to show that a bank would remain solid in the face of a crisis or a negative economic shock. So from a regulator point of view, the rationale that normally drives a capital increment is what they call financial stability and systemic soundness, such that if the banking system has, all the banks are at a certain level of capital. Another thing that could be driving it is that the Ugandan economy is projected to expand mainly from the oil and gas sector. And there are usually requirements that a bank can only participate up to 25% of its core capital in any one project. Now, by nature, oil and gas projects are large, and so it could be the case that the Bank of Uganda is looking at it preemptively. Those are some of the factors that I can think of that could have informed that decision. Now, the timing of it, that's quite something else. Thank you.
President, to bring you in, not so long ago we had a shake-up within the commercial banking sector when there were issues to do with opaqueness, when there were issues to do with internal mechanisms of management that enforce transparency. And largely that's what informed the corporate governance structure, the new corporate governance structure, which was part of the Financial Institutions Act of 2004. after about, eight banks folded as a result of, all these challenges internally. How has the Bankers Association received the proposal to raise the minimum capital from 25 billion shillings for commercial banks to 150 billion shillings?
Thank you very much. Good evening, our viewers, and thank you to NTV for inviting me. I haven't been here for a while. And every time we are live, we thank God. You know that COVID has had a huge impact, and I believe we'll speak a little bit about it. But coming back to the discussion, my colleague has spoken to us about some of the reasons, and he's quite right. First of all, on the minimum paid up capital proposed increases. In addition to what he has said, the background to this, and for the record, the circular was not the first time this matter was coming up to the industry. The central bank has been engaging the industry, both formally and informally. In April, the executive director supervision joined us in one of our monthly CEO meetings, and we discussed at length this matter. There are several reasons why minimum capital is being revised. First of all, the last revisions were around 2010, and for the case of the Tier 2, Tier 3 microfinance deposit-taking institutions, that was 2003, 2004. The economy has grown. I think GDP then was about $27 billion. Today it's in the range of $37 billion. Like he said, we have oil and gas coming. Today there's more risk than ever, not just cyber risk. Today a bank can come down just because of cyber. But there are more risks. COVID has demonstrated that quite well. Nobody saw it coming. We have a high risk loan book, the huge non-payment across all sectors. And yet the country wants more people in the money economy and to support the financial sector, to support growth across the economy. Across the region, the paid up capital for commercial banks and the other tiers, Uganda is the lowest. 25 billion is just under $7 million.
Kenya is about 30 billion.
Nigeria is 125 for foreign banks. Zambia has taken it up, Ghana, and so on. And the need for the financial sector, especially our economy, for whose private sector credit is largely driven by the financial institutions here. So a couple of reasons drive that. We will debate about the ranges and so on, but clearly there was need to marshal sufficient capital to sustain the type of growth, to manage the risks, the shocks across the industry. You asked me about governance and so on and so on. There are a lot of lessons, obviously, that led to those changes in the Financial Institutions Act, including limits on lending, sector exposure, the type of business you can do. Right now, financial inclusion is a big agenda. If you want to bring more people to the money economy, you have to have sufficient capital to deploy for some time without expecting certain amount of return. Because those are people who are not in the money economy. You have to bring them in and get them into the system. So that forms part of the reason for the changes. The governance around financial institutions has been strengthened significantly. We have a very strong regulator, by the way, even just in not governance, in risk management, in exposure. Like he said, they balance how much you can lend to certain sectors and so on and so forth to manage risk. Yeah, thank you.
Professor, to bring you in, if we were to look at the pros and cons in regard to this debate, there are those who argue that at the time the economy is badly hit, You don't have money, depositors' money within the banking sector. Banks are foreclosing on, businesses where people are not able to pay up the interest. Perhaps they could look at equity financing. So given the 3 years legroom that has been provided, there's hope that there's going to be perhaps a capital injection if the minimum capital requirement is raised. But on the other hand, there's also the debate that this could lead to concentration and edge out the indigenous players. How do you look at it?
First of all, Emma, thank you for having me, and good evening, viewers. I think, I think we all agree that there's a need to raise the capital of the banks. So we don't have an issue about that. But more specifically to your question, if you look at the pros and cons, yes, the issue that you have raised is that I don't know if there are really any truly local banks left in this market. So yes, there's a risk of more dilution of any local shareholding in these banks, if it does exist, when the banks pay up that capital. So a period of 3 years has been suggested, subject to approval of the proposal. And within that time, I guess most of the foreign banks should be able to comply. But when you look at the timing, you have a bigger problem that I don't know if Wilbrod would speak to it. Since we had the COVID pandemic start in 2020, Bank of Uganda kind of used a more kinder approach, a softer approach to the management of non-performing assets, and provided for credit relief for the affected persons, credit relief measures. So I think this has been done 2 times. Probably we're going to do it a 3rd time. And for me, speaking from the side of maybe a business person, there's a sense in which I feel that we have a problem in the economy, and the Bank of Uganda has been helping the commercial banks kick the can down the road. So at one point we are going to have a day of reckoning. Yes, it is true. I don't know what the true ratios, if we didn't have the credit relief measures, the true ratios of the non-performing assets would be. We've had an economy that's partly locked up and continues to suffer in very many respects. Sectors like education have really been badly affected. I definitely know if a sector like education is affected, then there are multiplier effects in areas like agriculture and the like. So definitely we have a problem brewing. So I think in coming up with this measure, Bank of Uganda is trying to anticipate what is going to happen in a few years' time. Definitely the banks are going to need recapitalization as the write-off a lot of these non-performing assets that have arisen out of this COVID pandemic. So it is in that context that one begins to think that Bank of Uganda is being astute and is being forward-looking. That look, there is an issue here, and we're going to deal with it. However, if you look at it in terms of an ideological issue, I do not know if we are still interested in having ownership of the financial sector or controlling the financial sector, and what really the pros and cons are of that. But Wilbrod could speak to that again, but definitely I think we no longer have control of the commercial banking sector. If you really go back to the time that we did the structural adjustment, the arguments we made at that time is that if we liberalized the financial sector, we would be able to bring interest rates down. Now, there's so many moving parts, and these have changed the game. And as a result, really, I can't go into that now, but as a result, I do not feel that interest rates have come down adequately. But also, on the other hand, we did suggest a number of intermediation measures in terms of refinancing UDB so that it would take on some of the more socioeconomically desirable projects, in terms of having more government intervention in the sector through consolidation of organizations like Postbank and the Microfinance Support Center for some of these projects. And those processes have been slow. So if the government cannot find the money, then I don't know where any Ugandan in the banking sector is going to find the money. So yes, what you're going to end up is going to have concentration of commercial banking with the foreign banks, because they have deeper pockets and they have offshore partners who can help them meet this capital requirement in the stipulated time. So I guess that's where we're going. We have a day of reckoning when Bank of Uganda says no more credit relief measures, so I don't know what's going to happen.
Abeka, to bring you in, you currently, as we speak, you have many banks already struggling to pay the minimum capital requirement, and you're raising it to 150 billion shillings. So in essence, the smaller banks are going to be phased out. But two, to attract the HSBCs, definitely you need a robust economy. Any commercial bank wants to come in where they see opportunities away from the oil and gas sector, which is also competing with the emergence of renewable energy and the delays in investments and all these kind of things. What is that thing that's going to attract the folks from outside to invest their money, to come in and establish banks here that are robust, that are going to, improve our economy?
Thank you very much. I just wanted to add, before I go to that question, when you look at the pros and the cons, the first thing that I need to communicate here that it doesn't necessarily have to be a one-size-fits-all capital requirement approach to start with. During the financial crisis, it was established that there are banks that can be categorized as systemically important given their integration with the economy. Now, I've been trying to mention names, but I think I can mention some names. The Stanbic is a very large bank. It's systemically important. The capital requirements we are talking of, they already have that kind of money. Now, what are the pros? If they are forced, for example, to raise the capital requirements, in theory, they will raise that capital. Now, whether the capital, if the capital comes from externally into the Ugandan economy, it somewhere reduces the pressure on the current account through the capital inflow. Now, the risk that Professor Sejaka was speaking to of dilution can happen in certain banks. For example, the Ugandan banks, according to me, are Housing Finance Bank, a tier 1 bank. I think it's 50% owned by the NSSF and the government of Uganda. Then you've got the Post Bank. And then in tier 3 MDI, you've got the microfinance, Pride Microfinance. Now, the real risk there is that if they go through the kind of battles that Professor Sejaka went through to raise capital for UDB, then they might get diluted if the regulator insists. But if they get diluted, depending on the proactiveness of the savings institutions that are local, the scenario can end up being different. So I can give an example. The NSSF at the moment, before COVID, was raising more cash flow than outflow, more cash inflow than outflow, therefore having the outlay to participate in these opportunities when they come. So that's on the capital side. On the economic security side, there's no argument that it's a clear pro if banks are better capitalized. And this is the logic I think the management, the new management of UDB used to struggle so much to explain to MPs that they needed to capitalize the bank in terms of equity. Now, equity always multiplies your capability to get debt capital because of the debt equity ratio, which is a standard that you use to try and, get more capital. So every time you would try to arrange a loan for the UDB, it would be difficult for them because their equity was very low. So those are the clear pros. In terms of the way the banking sector is set up, why we should not worry so much is that it has got the three tiers. The first tier, those are the big ones. They're all international. The first tier, of course, is Stanbic, very international. Then you've got the regional banks that are quite large, very well capitalized, KCB, Equity Bank, then the Pan-African ones, Eco Bank, and then the local bank that you could speak of, sir, is Centenary Bank. Well, it's also very, very strong. I don't think it's going to have challenges raising this money. But
Wilbur would speak to Centenary Bank. I know they have some foreign shareholders there. And I think the risk for a bank like Centenary Bank, but I think they would meet the capital requirement. But if they can't,
definitely,
then you would have those foreign investors diluting the local ones. But I don't know if that is really important. I think it's...
So to answer the question directly, attracting the big banks now is about the structure, because that's why I was speaking about the tiers.
Yeah.
So just if you could give me a minute. So the smaller ones, or the MDIs, they bank with the big banks. So it is kind of flowing like an apex from tier 1 to tier 2 to tier 3. So the SACCOs, the savings and credit cooperatives, some of them have grown quite big. For example, there's a very big one in Masaka called Mami Dekot. It's now a multi-million-dollar organization. Now, if the mindset is such that they are able to participate in the capital raising, then it could be the opposite, that the banks are owned indigenously. Now, it's very important to compare the story of KCB and the story of Stanbic, i.e. UCB. In KCB, the government of Kenya preferred to float the shares on the market, but maintained a certain amount of holding. In Stanbic, we didn't do the same. It remains a systemically important bank. So how do you get the big ones to come? My personal opinion is that now you need to create the tier of a wholesale bank. I feel that a wholesale bank is missing in the equation, the one that would now bank the other banks, and that would be the one now that has sizable capital and then could influence the price of money. The second way to do it is to make clear the rules of investment banking, which are now not so clear between the central bank and the Capital Markets Authority, because the investment banks would then allow banks to have a little bit more freedom in lending, because the challenge is that as a company grows, it obviously needs more capital. And it cannot only always be debt capital. So where there is a market where equity capital is almost non-existent and banking capital is prevalent, then the financial system becomes short and favors trade as opposed to projects that could be more productive. So it is important when you're doing the regulations to balance between what incentives you're going to create that will allow big investment banks to come in. So I'll give you an example. In Kenya, investment banks that are investing in the shares of companies to develop them, then they sell them later, are excluded from capital gains tax. In Uganda, it's not the case. So one of the guys tells you that, okay, I buy a company at $1 million, I grow it up to $3 million, and then when I'm selling it, the government takes a chunk of the money. In Kenya, just next door, I won't do that. So there are certain policy areas that, number one, it doesn't have to be a one-size-fits-all regulation, which means that you allow the small guy to survive. Two, you have to diversify the sector and allow for a wholesale bank. Then three, we have to start looking at the fiscal policy for allowing big equity banks to come in. That's it. Thank you.
Mr. Wilbred, to follow up from what Baker says, perhaps can we then allow some of these banks that have liquidity challenges, perhaps do they then move to the phase where they become microfinance deposit-taking institutions, for instance, so that they can actively participate from the context that we still need the indigenous sector to remain robust? Professor Ezra Surma, who was the former finance minister and MD for UCB, makes a very compelling case that UCB was largely the pulse of this economy, and once we sold it through a quite graft, riddled process, we were at a loss as a country. What's your view on that?
Thank you very much. Let me speak to a couple of things that my colleagues have touched on. The debate about indigenous, foreign banks. I'll speak to something about interest rates briefly, and the various models and tiers of commercial banks, including the issue of DSIBs. DSIBs mean domestic, that is in the country. Domestic in this case mean within the country, systemic across the entire economy, important banks. The whole idea there is that if anything happened to such a size of a bank, there would be huge ramifications for the country. So there are 5 in Uganda. That is Stanbic, Standard Chartered, Centenary Bank, ABSA, DFCU. And what the whole idea there is they have slightly higher demands on them, placed on them because of the impact if anything happened. And indeed, capital is one of them, but there are other weightings and measures that are applied to them more. This debate about indigenous, domestic, foreign banks is an interesting one. In other jurisdictions, there is what they call discriminative regulation. In Ghana, in Nigeria, I think even in Zambia, I think the foreign banks, for example, in Nigeria, the paid-up capital is $125 million. Then you come to the domestic or national bank operating across the country is $62 million. Then the regional bank, because Nigeria is big, just a state or a region can have the bank that just operates within those borders. In Uganda, we have tiers. Tier 1, which is the tier 1 commercial banks, tier 2, the microfinance, credit finance, and then tier 3 is deposit taking. And they are meant to serve different segments. It is always good to attract as much capital as possible in a country so that capital flows in a country. And the foreign banks bring this. But it is also possible that if you want indigenous banks to come up, there is nothing with listing them and mobilize capital so that you have more subscribers. Perhaps this is an opportunity, like he said. And I know there's conversation going on in that area so that the capital markets listing is encouraged and more capital can be mobilized. You may be surprised. There are Ugandans here and outside who could put in a lot more money. It is when a bank has large balance sheet supported by capital, it is able to deploy it and do many more things, and it has an impact on the pricing of credit because it is sitting on a larger base. There are huge operational costs in running a bank or financial institutions, and size of capital is quite critical in it. The question of UDB is another interesting one. My understanding and schooling is that UDBs, the EADBs, and all these are members of UBA, by the way. Both the 2 development banks, all the commercial banks, and the 9 MFI and MDIs. There are 35 members. Development banks, by their very nature, are meant to be long-term funders for larger investments that require patient capital. Commercial banks, by their very nature, are short-term in nature. They depend on deposits, your deposits, to lend. And therefore, they can only lend for a certain period, a shorter period, particularly working capital or medium term, 2, 3, up to 5 years. And therefore regulators across the world watch to safeguard depositors' money, and therefore capital speaks to that. And I think increasingly we must address issues of the shortage of long-term capital to develop those other infrastructure projects and development projects. And there are many ways of doing that, including attracting DFIs, development financial institutions, especially when you give them stakes in the institution or frameworks that enable them participate in decision making and control. I think that there is no cause for us to panic too much. There is space for everybody, and that's why there are tiers. And therefore, in the event that, and there are a couple of options. One is to make sure the shareholders are mobilized to meet new minimum requirements. Of course, we are debating with the central bank on how much time can be allowed and milestones. Can you say by first year I should be here, second year or third year, and so on. So the first is to mobilize shareholders and get to the number that the central bank requires. The second, if you can't, is to go to the lower tier and play in that tier. The third, of course, is to merge, okay, and form make a new formation, structures, and so on and so forth. And unfortunately, if it is tougher, then you really have to choose where you want to play. But the good thing that that is happening is we've had meetings, and we had a meeting this week. And we discussed a number of things, including timing. We are still having that dialogue, including what to consider as capital. The capital account.
We haven't yet agreed.
The capital account has several other things. There are reserves, there are retained earnings, there are share premiums, and so on and so on. Will those all be factored into it? There are issues around if you're mobilizing that amount of money, there's stamp duty, there's registration of new capital amounts. All those have cost implications. There are now discussions, and we've put across quite a number of proposed reforms of even if I'm in this tier, but I'm serving this segment, can I enjoy certain benefits that are reserved for tier 1 and so on, so that we address national issues of not just financial inclusion, but specific segments that are underserved currently. Luckily, the central bank says between now and up to December, there's going to be a lot of consultation and discussions, and all the issues we've covered in our conversations with them. There are matters we are going to continue to talk about. I believe at the end of it, whatever framework we come up with will still be very good for the economy. I also want to quickly assure our audience that even with the proposals put across, all the financial institutions in whatever tiers they fall into are being looked after well, and there is no reason to panic. There is even sufficient time that this has been given, and I think that we will work well on this and deliver it.
Professor, definitely this is still a proposal. It's not yet law, and there's going to be lots of, I guess, backroom kind of discussions to ensure that it serves the interests of the banking sector and other financial institutions in the country. Given the 3 years for now that we're discussing in the proposal that has been given to financial institutions, do you think this period is, good enough in the context that by then, by the time we come perhaps to the end of this economic tailspin as a result of the COVID pandemic, the financial institutions will have, raised this money, and in your view, this capital injection, which if it's enforced of 150 billion shillings, it could bring in trillions into the economy. How can this largely improve an economy that is just coming from being ravaged by the COVID pandemic if it were implemented?
Interesting. Let me make a prediction. I'll go on the edge of the precipice. I think it's going to happen. It's inevitable that the banks are better capitalized, and I think all your panelists tonight have agreed that it is a good thing for a bank to be well capitalized. So the devil is in the detail. So I think that's going to happen. For the banks that will not be able to raise this capital, I think they're going to have to, we're going to have some tectonic shifts in the market, in the sense that either you merge,
Yes.
or you sell out your interest to a bigger player because you have a license, and that's a very valuable thing. So definitely there's going to be adjustments in the sector. And that is all for the good, because as I have said, we are yet to actually feel the true impact on the financial sector of the pandemic because of the relief measures that Bank of Uganda has provided. But that time will come to an end when we have to deal with these issues. And I guess part of the process of increasing capital is to deal with what we anticipate is going to happen. So it's a good thing. But I don't know, I would like to throw the ball back to Wilbrod. I'm sorry, I'm taking your, I'm now sitting in your position. Because from my experience, is we are talking about the commercial banks. But you know that the telcos are muscling in into this space. And there's a lot of lending going on there. So what exactly is going to be the impact of the telcos? And that's what the Bankers Association should be speaking to. I know there's been a move for them to form holding companies to deal with their mobile money business. But this thing keeps on growing.
There's lots of money.
Yes, so there's an elephant in the room there. Yeah. And if it is not regulated, it's going to have quite a number of issues there in terms of, one, the interest rates that they are charging, which are usurious, and that's something you need to speak to. And two, the fact that they are using short-term money to do very short-term lending. So there's a balance, the shift in the balance of the type of resources that are available in the economy. Less patient capital, more current capital in the market. So I think that's part of the shifts that are happening, and those are some of the things that need to concern us. But overall, to speak to the issue of increasing the capital, if you give the banks time, they should be able to do that, and that is a good thing for them to do.
Mr. Wilbrod, perhaps to tweak the question, it's perhaps a good thing that you create this financial stability through raising the minimum capital requirement. But the debate, which moves away from the form to the substance, is you have the great banks coming in. How is the, and yet already there's a trend that many of the foreign banks here charge very high interest rates, quite out of touch with the cooperatives and the other microfinance, the other tiers that lend to the ordinary people at the grassroots. Don't you think we're creating an elitist, we could create an elitist banking system that edges out the ordinary person?
Not at all. Thank you very much. Let me spend some time on this. First of all, it is not true that the foreign banks charge very high interest rates. They actually have one of the most competitive rates for the various international banks I know, especially at the corporate level. But let me speak to one or two things that Dr. Sejaka has mentioned. First of all, from a non-performing loan portfolio point of view, nobody saw COVID coming. And we are coming to 2 years in it, and there's no sight that it is about to relent. We could have a third lockdown and so on, especially if the vaccination is still a challenged area. In the process, yes, there have been credit relief measures, but like he said, it is postponing a challenge. As we speak now, sectors that have remained closed, like the education sector, there's a huge non-performing book because they can't pay, they are not receiving cash flows, not just for day-to-day running, but they also borrowed money to expand hostels, administration block, classrooms, and even with the restructure, which means deferring payment or extending it for a longer time, it accrues interest, which is capitalized.
Actually, UDB is not lending to schools that are trying to expand.
And the loan book may become bigger than even the collateral. That's a huge risk, leave alone even trying to sell it and nobody can buy it or even realize the prices you want. So it's a huge problem. And like he said, behind the school is not just the teacher's salary and so on. There are people who supply food, stationaries, uniforms. There's a whole economy behind schools. So by actually intervening in schools by itself, you can impact 4 or 5 million people, hundreds of thousands of businesses. But the point I'm making is that the banks have been carrying that risk for having lent. The facilities are non-performing, and it gets to a point where there are loss accounts, you have to write them off, and that impacts capital. So yes, it is prudent that Bank of Uganda is taking a forward-looking position that we prepare in advance for that. That's a very important control and risk management framework. The issue, like I want to repeat, it is always good to attract more and more capital. I think that one of the ways, and we brought this in the discussion with Bank of Uganda, is that there is room for us to approach it in many other ways and enhance and still achieve and allay the fears that indigenous or local banks may be aged out because of inability to raise those levels of capital. There is enough room. You can either play in some of the lower tiers, but even other discriminatory regulatory frameworks can have capital requirements for domestic or indigenous banks. Again, those are considerations without losing the advantage of the need for mobilizing capital. Okay? So there is still quite a bit of conversation, but that may not be the biggest thing. There are ways of empowering indigenous people to participate. There are also banks, we mentioned Housing Finance, Pride, Post Bank, and so on and so forth. What's wrong with the capacitating them to the levels that are required so that they play in those sort of leagues? Okay? I think there are a combination of things that can be done. We have put across all these, including looking at certain sectors that have a huge impact on the economy that can help the economy grow. He mentioned one thing that I finally want to respond to. They are now, with the passing of the National Payment Systems Act, it now regulated the mobile money arm of the telecom business. They are regulated under the National Payment Systems Act by the central bank. Yes, they are providing payment services and extending credit on the phone. There are risks inherent in that, but they play with big numbers. As of the last figures I saw, they were doing 323 million transactions per month. Those are huge numbers and impacting a number of people. There is risk there, but all that money is mirrored in the banks. Although you see it on mobile, but it is backed up in the financial system, and it is important that the banks that hold this, as it grows, have sufficient capital to run with it.
Thank you very much. We are discussing the veritable subject of increasing the minimum capital requirement for financial institutions, and we have a panel of 3 gentlemen this evening in the studio. We'll be taking a commercial break, and we'll soon be back with this discussion. And our hashtag is Amplifying Citizen Voices. A panel of 3, Abeka Mayanja, a financial economist, Will Brodowori, the President, Uganda Bankers Association, and Professor Sejaka, an accountant and finance expert. Back to you, Abeka. The issue of technology within the banking sector, and which is also an issue of concern in regard to the stability of this sector. Some people view it as a double-edged sword. It's good, it's a versatile way of doing business. But if you don't have enough checks and balances, there are so many issues that could arise. We also have the challenge of illicit financial flows. Many of these foreign banks are domiciled in safe havens and secrecy jurisdictions and have a very complex structure of moving money and concealing money in order to avoid paying taxes. How do we deal with these issues within the context of this debate?
Thank you very much. I think the best example that can illuminate the importance of technology is atomic energy, which can power a city or it can destroy a city. Now, Professor knows business models, and he knows that technology enhances an existing business model. And let me just throw more light on that. If you run a bank and you literally have to set up a branch everywhere, it's too expensive. But if you are somehow able to reach your market through mobile technology, the assumption or theory is that technology will improve the business model, and that means that the cost of delivering the service will go lower. And that means interest rates will go lower, and the logic follows that the economy should expand as a result of that. Now, where Professor Sejaka had a concern is that instead of technology achieving this result, is that the technology rails that have been created to create better retail banking and better services has also now become a credit provider at a much higher interest rate, which he called usurious, and he was not wrong. And why is that so dangerous? Is that one of the most common theories of finance is that the moment you have high interest rates, you attract higher that then create the whole system to implode because the good borrowers stay away. The second aspect that is so dangerous, because one of the most famous economists, Adam Smith, talked about interest rates in a very detailed way. And his assumption was that the interest is supposed to be a share of a profitable venture. And why has the technology now come with an adverse effect? It has come with an adverse effect in terms of price, number one, an adverse effect in terms of becoming a competitor of the very business models it would have enhanced, and three, consumption or consumer lending versus productive lending. And that means that it becomes the biggest risk. And so when you look at the regulatory environment, if you look at capital adequacy alone, then it does not help you to achieve asset and liability management, because assets that have very high interest rates of over 100 are eventually going to create a risk in the financial system. And it may not be that it hits the financial rails. So if you're delivering matoke to Kampala, that's the technology. You're going through a road. If that road gets a problem, Masaka and Kampala will get a problem. What do I mean? Even if the money sits in a bank, if there is an adverse effect as a result of high interest rates, that will be the issue. Then going back to this very topic, you were talking about the cons. I heard people talk about mergers. Now, one way to measure competition is the concentration ratio. What percentage of the assets are controlled by one entity? So if they merge, you reduce competition. When you reduce competition, competition brings inefficiency, which brings higher prices, high interest rates, and high interest rates then take you back to the theory I was telling you that more risky borrowers come, and then you achieve the opposite of what you are supposed to achieve. And there are other issues. Again, the point I made about one size fits all is not the approach for the modern day era. So by saying you're creating the same capital requirement for Postbank and Stanbic, you're not actually creating or getting a good result. Instead, Stanbic is a more systemically important bank that you should tell this is your capital level. So when you go down to the level of the MDI, for them $1 million is a lot of money. And so it is very important to take a seat back. Then when you go into regulatory economics or regulatory affairs, I'm glad that you're having this discussion. There's something called a regulatory impact assessment methodology that will look at the environmental factors, the social factors, and the timing, basically. And so the short answer is that the technology needs to be driven to make the delivery of services from the companies licensed that are more competent to deliver better. Or if there is competition, a systemically important technology provider needs to be regulated not to lock out competitors. I think that makes sense? Because you are trying to achieve competition and price effectiveness to create efficiency in the economy, which is what economic policy is all about.
Wilbrod, the question of mobile money, which plays quite a critical role in this economy, where does it lie within this debate? In the more advanced Western economies, cryptocurrencies are gaining quite some traction, and there are banks that think that they have an intrinsic value. For instance, Bitcoin, which was a few months ago valued at 5,000, is now worth $20,000. Since our economy is largely playing out within the mobile money sector, where does that fit within this debate?
Thank you very much. It fits very well, and I wanted to make this point when we went for the break. The financial sector has evolved quite a bit beyond the traditional, commercial or banking service providers. Today, there are different and numerous players and growing by the day. The MNOs, as you know, are playing a critical role through the mobile money, and they turn over quite a bit of volumes over there. They have more fintechs, aggregators, and now they are tech fins as well, technology company, turning into financial institutions. So they are part of the equation. They complement, but in certain areas they compete. More importantly, they are penetrating areas which my colleague Mayanja has ably put across, that in there lies risk, because they don't have certain frameworks that support underlying risks. And in there they are getting into areas where they can be non-performance. As you know, lending can have repercussions. And if there's a shock in the system, where is their fallback? The good thing, they are now regulated, and regulation will guide in areas they play and to what extent and how much risk they can take. This is the beauty and objective of bringing them under regulation. And technology continues to evolve. The cryptocurrencies are new technologies. I believe central banks globally are studying them. They have been faster adopters. There are certain inherent risks that they are being cautious about as they take the technology forward and embrace it. But all those go ahead to reinforce and speak to the need to have stability and sufficient fallback in case a risk crystallizes. I'm sure you have followed some of the frauds in some of the systems or cyber challenges. And they have huge financial impact behind there. So if you are not strong to withstand that shock, it can shock the system and have repercussions. And that's why, as we strengthen security systems in our financial or digital services, it is also backed, by the capital behind it. I think the debate that we are having, and I agree entirely with Mayanja, and we've put this across to the central bank, is that there doesn't have to be one standard. Different financial institutions play different roles, and they can play in different tiers and play very well, okay? And therefore there can be different amounts, even wider than the range that has been put, so that they address specific segments of the market and needs, and by extension are allowed to take only a certain level of risk, which is exactly what he said. I think increasingly, as other players, the non-traditional players come in, the fintechs, the tech fins, the MNOs, those similar risk frameworks will begin applying to them. I just want to speak about the issue of pricing. A lot goes into pricing, and technology, no doubt, was one of the things meant to bring about the efficiency and by extension lower the costs of transactions and pass that benefit through a good price to the final consumer. That has not necessarily happened. Some of the lending rates, by the way, in these areas, they charge them per day, per week. If you analyze them, if you make them an annual rate, interest per annum, you will find that they were way past what the traditional financial institutions are offering. And those are some of the things that some of these measures may address, but also more use of better technology. And as we improve the risk profile of the borrowers and the culture of repayment and the amount of information you have before you make a lending decision, all those things are factored into the pricing of lending. And as you come more and more regulated, those questions are asked and how you arrive at them to inform the pricing. So I believe we are in a journey. I think that we can continue to perfect them as we go along the journey, as we leverage on all these technologies, collaborations, risk management aspects, and so on.
Professor, in your view, do you think as this tectonic shift emerges, perhaps there could be an opportunity for the indigenous banks, for instance, Housing Finance Bank, to get into niche products if they are capitalized and specialized in those areas?
I would agree with you, thank you, Emma. I would agree with you that there is always an opportunity to get into niche products. But as Wilbrod was speaking, something came to my mind about the whole concept of regulation. And I think the problem goes back to what happened with the structural adjustment is we kind of removed all the controls. And then after we'd done a lot of structural adjustment, we kind of slapped the controls back. The way we want to control this economy, which is actually a very pre-industrial economy, it's a very basic economy. We are trying to use very sophisticated tools based on Basel standards to regulate. For instance, we now move to risk-based supervision. And that is very onerous for the banks. We brought in the idea of business continuity, and we're saying you need to have a backup, data backup. I think when we had the problem of Imperial Bank, and they said their data backup was in Nairobi, then the regulator said, you need to have a local data backup. And you're talking about somebody investing $3 million in an off-site data center. So there are some regulatory practices that I think are too sophisticated for a pre-industrial economy. And they only serve to increase the cost of money by making it onerous for the banks to lend for some of the activities that we would expect to take place in this economy. And now, because some of the lenders cannot meet those conditions, you create a vacuum. Now, nature abhors a vacuum. That's why you have the money lenders flourishing. That's why you have now the MNOs coming into this space. And I agree with Abubakar that this is now creating risk. So where does that risk lie? Because the money is with Wilbrod's people. So where will that risk lie? So whereas there are opportunities that are coming up because of the rapidly growing economy and the changes that are taking place, we need to reset and rethink the regulatory paradigm. How do you regulate financial institutions in a pre-industrial economy? Is it fair to regulate Pride Microfinance the way you want to regulate Citibank? So much as you also want to have different capital requirements, they are also going to require different standards for regulating local banks. I mean, one of the banks I work with, which I will not name, does not have online banking, but they give me a very good service. But this bank, which doesn't have the online banking, is in the same market and is having to compete with the likes of the tier one, the SIFIs, the systemically important financial
If
institutions.
its clientele is a rural
Exactly.
community
So
without mobile phones.
You are always going to find that when you have those kinds of discrepancies, how do you enforce first world regulation on these financial institutions?
Very interesting.
So you always, whenever you enforce them, you create gaps, and then you create those situations. But definitely, speaking to another issue again, which comes to my mind, is the issue of access to credit. You see, the world economy developed because it has access to credit. Here we remain poor because we don't have access to credit. Whichever way you look at it, international requirements and that's why you see, I said that the increased 150 billion is a nice thing, because if you have 150 billion in a bank, you should be able to lend it up to 10 times, okay? Or maybe 7 times, so that you are creating money in the economy to grow the economy, to grow the business, to accelerate the rate of transactions. You know the other joke about the traveler who walks into a town and he has the $100 bill. So he asks to go and check the room, and he leaves the bill at the counter. So as he's checking the room, the hotel owner pays the butcher, okay? The butcher then also pays the supplier of the cows, who then comes to the hotel to pay his hotel bill. And then the traveler comes out and says, I'm sorry, I'm not going to stay, and I have my bill, my money. So he gives back the $100 bill. But all this velocity has created an economy. And that is what is happening here, that are we able to create enough credit with the kind of regulation we have in this economy? And that seems to be a roadblock. Again, the banker is here. He needs to speak to that. How can we overcome these barriers, or the dichotomy between a first world regulatory system and the banks which have to operate in a pre-industrial society?
Largely an informal sector. But gentlemen, we're coming towards the end, and I beg that we use a minute to wrap this up.
Thank you.
First, and then.
For me, to wrap this up, the government actually has a very good framework for regulation. And you're supposed to carry out a regulatory impact assessment. It's rarely done. If this is done, some of these issues that are being raised will come out. Then very quickly, for niche banking, support, for example, some banks that were in the housing sector, it's an essential economic requirement, would have stayed there and become important in that sector, but they would have lent other banks. So for example, to use a very lively example, a bank that is well capitalized doesn't have to go to Lira. You can lend to another small bank or institution or in Lira. Then the third thing is that the Financial Institutions Act has recently been amended to include Islamic banking, to include bank assurance, and to include agency banking. And it would have been more prudent to really dig into these things and see how they are coming. So if there is no Islamic bank yet it's equity related. Now during the crisis time, the effort should have been to create this so that it kind of reduces the pressure on the debt to avoid the crisis that Professor has predicted. So the solutions do not necessarily lie in a simplistic increase of capital per tier, but to look at fairness and relevance. If you are a big bank, you don't your capital requirements are going to be different from a smaller bank. That's thank you.
Mr. Ower, your last one.
Thank you very much. I think I wanted to say that we clearly recognize these various moving parts. Last year, in 2019, we had a session with Bank of Uganda and agreed on a range of reforms. We have completed putting that together, and we'll be handing over to the governor later this September month. A couple of reforms and proposals that include, among others, the regulatory burden that drives costs of compliance, the issues of segments to serve, and the roles that different levels of banks and tiers and types of banks. There are different types of banks beyond just commercial or development. And those are quite many, and they can play and fill in the gaps that our country needs. Dr. Sejaka also talked about the challenge between our pre-industrial and the modern day regulation. Unfortunately, because the financial system is globally networked, you require certain standards to be similar. Otherwise, correspondent and international flows, they treat you differently. That said, there can be a regulatory framework that caters to different segments across the